is for that week of July 4th. Otherwise, I will turn it over to Chelsea, and thank you very much, Chelsea, for joining us. I really appreciate you taking the time to bring us up to speed a little on valuation and due diligence, which is the world you live in.
It is, indeed. I started my career on a short-term fixed income trading desk at Bank of America in New York. And I spent several years trading money market and then eventually high yield, which is also known as junk bonds. And then switched over to private equity. I was with a small lower middle market fund in New York for quite some time. Went back to get my MBA at UNC. Returned back to the PE fund, and then kind of wanted to switch gears outside of the PE world. Found out about Carolina Angel Network in 2017, and I have been here ever since. So.
Wonderful. Well, nice to have you with us. A little bit of background on the Carolina Angel Network. I did want to mention to everyone here, the 2 weeks from this session is actually the week of July 4th. So I kind of wanted to take a poll. The person who we were looking to have present is not available. So I didn't know we could kind of push up or push the talk that he was going to give to the 13th. And we can cancel altogether depending on people's availability, or we can identify I guess the third or the fifth rather presentation and kind of pull that up. So depending on your availability, we are going to be going over, for that one, we were going to be going over revenue projections and kind of just a high level overview as to the key things to look for within revenue projections, how to map it out, things of that nature. And Taylor Meyer from Hyperspace Ventures is going to be joining us for that topic. So I'll take a poll and send out an email to just see what people's availability is for that week of July 4th. Otherwise, I will turn it over to Chelsea, and thank you very much, Chelsea, for joining us. I really appreciate you taking the time to bring us up to speed a little on valuation and due diligence, which is the world you live in.
It is, indeed. So my name's Chelsea. I'm the director of the Carolina Angel Network, and you guys have my contact information there. I'd say let's make it interactive. If you guys want to jump in with questions as we go instead of waiting till the end, that's completely fine with me. It doesn't look like we have too many people on here, so let's keep it conversational. So what is the Carolina Angel Network? It's part of UNC. It was created about 3 years ago as a way to connect UNC affiliated investors with UNC affiliated startups. So what I mean by UNC affiliated is anybody that is an alum, a student, a parent of a student, a professor, anybody that's been employed by the university is considered UNC affiliated. So what we do at Carolina Angel Network is we will screen potential investments that apply to the network for funding. We'll narrow them down to about 6 to 8 per year, and we'll conduct due diligence on them and show them to our members. And our members are all accredited investors. They're sophisticated angel investors. Some of them have been doing this for a long time. Some of them are just learning. But what they do is they'll read our due diligence report and they'll decide if they want to invest in any of these startups. So the deals that we typically look at have early customers and early revenues. They're typically in the late seed / early Series A stage. So they're past just a concept and idea. So they have customers, they have revenue if that's applicable, or they're very close to getting that first early revenue. We have done, we've invested about $12 million over the last 3 years in 19 companies. We've done several follow-on rounds, and we have about 186 members. They're all over the United States. We have some internationally, predominantly in the Triangle, but they're as far as, I think we have one in Singapore, many in California, a lot in New York, Atlanta, whatnot, and so on and so forth. So that's what we do. We do the due diligence. We'll act as a lead investor, and we'll put together all the closing docs. We'll facilitate those closings for the investments, and then we'll monitor the portfolio companies after we close the deal. So right now we have about 20 companies that we follow, just that are our investments. And then we also follow the companies that might apply for funding but be a little bit too early, or they might not quite be there and ready to for us to invest in them yet. So we'll follow them, we'll keep up to date on their progress, and we'll track how they're doing so that maybe down the line they'll be ready for investment. So that's a little bit about CAN. So what you guys really want to know about is how to value a startup and how we do the due diligence. So I'm going to start with how to value a startup. There's really not a tried and true one-shot way to do it. It's more of an art and a science. So I'll go over the science, and then I'll talk a little bit about the art. So 3 different ways that I like to value a startup is a multiples method, a price per employee or user, and then something that we call the VC method. So we'll start with multiples, which is probably a little bit more common. Price per user and employee is something that we might use for pre-revenue, or something that isn't going to be generating revenue for quite a while. And then VC method, I use it as somewhat of a checks and balance. Once we do determine the pre-money valuation, I do a little VC method to make sure that it actually makes sense. So let's start with the multiples. I'm giving an example at the top, and then talk about how I value each of them. So in the first example, we're looking at a digital health startup that generates about $7 million in annual revenue. So what I would do is go and look at comparable transactions in the digital health space by looking at companies that have been acquired within the last 2 to 3 years that are relatively the same size as this digital health startup, and where we expect it to be within 5 years. So in this example, I would have seen that comparable transactions traded at around 5 times their revenue. So for example, if a company was generating 100 million in revenue and it sold for 500 million, it's trading at 5 times revenue. So in order to value this particular digital health startup, I take that 7 million that it's currently generating and multiply it times the multiple. So 7 times 5 gives you a pre-money valuation of 35 million. I don't know how familiar you guys are with pre and post money, but pre-money valuation gives you a snapshot of how much a company is worth prior to any money being put in. So I'm going to jump on over to the VC method. I guess let's take this digital health example and use the VC method on it. If the pre-money is 35 million, and for example, they are raising $5 million, the post money on that is going to be the 35 plus 5 million. So the post money is going to be 40 million. For pre-revenue companies, the ways that, and there are several different ways, but I just picked a couple, but the ways to value a pre-revenue company is sometimes per employee or per user. So if you have an app, You could do it a price per user. And if you have, for example, an AI company, we have a portfolio company that we valued on a per employee basis, because comparable transactions usually trade at a dollar price per full-time employee. And the reason for that is because AI employees, the engineers are really good ones are extremely hard to come by, and they're worth quite a bit of money, as you can see in this example. So for this example, we looked at an AI company that had 4 full-time employees. They were very early in their life cycle. And I looked at, what are larger AI companies trading for per full-time employee. Went through some comps and discovered that they traded about 6.8 million per full-time employee. So we just multiplied the 6.8 times 4 to get a 27.2 pre-money valuation. It seems extremely simple, and it is, but the hardest part of valuing a startup, in my honest opinion, is finding proper comps to use to find these multiples. So what I will do is I'll look through Cap IQ is a good database where I can find a lot of multiples. I'll look through the TechWire, which has transactions, and usually you can find information on them. Searching through Wall Street Journal and other databases that have comparable transactions that you can look up and find this information on. I wish I could say there's one perfect place to find all of this, but it's usually me having about 15 different tabs open and pulling together a good list of 6 to 8 comps, and then looking at the median and the average multiple of those comps. And the most simple is the VC method. So I'll tell you about the VC method and tell you why it is not the best thing to do. But typically founders expect to give up anywhere between 20 and 25% equity per funding round. So if somebody's looking for 1.5 million, you can kind of expect a reasonable valuation to be 6 million for that. So you take the 1.5 million that they're looking for and divide it by 25% to get that 6 million. So if I had a company come to me and say, hey, I'm looking to raise 1.5 million, but the pre-money valuation that I want is going to be, 20 million. Clearly you can see that that's way less than 20%, which is a good rule of thumb. So right off the bat, I know that that's unreasonable, and it's not going to be a very good pre-money valuation for that startup. So the reason that I say it's not very good is because the biggest variable in that VC method is how much the founder is looking for. And that's not always the right number. So this founder, for example, might be looking for 1.5 million, but depending on what they want to do and how far they want to get with that money, it might not be the right dollar number that they should be raising. Maybe they should raise less and have a lower valuation, or raise a lot more and get some more runway, and it could justify a higher valuation. So those numbers have to be pretty precise in order to make sense. So those are the 3 different ways that I typically value a startup. That's the science. The art part of it is if you have an extremely fast growing company that could warrant a little bit higher of a multiple. So if that digital health startup that was generating 7 million in revenue was generating 4 million in revenue last year, clearly they're a year over year growing quite a bit. So I might bump them up to like a 6 or 7x revenue multiple, give them more of a premium for that. Other arts is looking at the founders. If you have an extremely exceptional founder, which is, in my opinion, one of the most important things that we look at in startups, then I will put a little more of a premium on that. If I'm trying to think of a couple others. If the market's just absolutely ginormous, or if they have some rock solid IP, a lot of different levers can be pulled there. And also on the reverse end of that, we can bring that multiple down if there are some hairy parts to the deal or whatnot. So that's kind of the art and the science. There's really no perfect way to do it. It comes with practice. So I've valued quite a few companies in my day. And it's not something that you can just look at and value in 10 seconds. You actually need to put some thought into it, look at the multiples, look at where things are trading, make sure that the percentage adds up, look at the overall picture of the startup in order to come up with a value.
Chelsea, could you talk a little bit about, when the very early stage startups that, we have at Kickstart, where they don't have any revenue yet, and they might have some predictions, but that you'll also be convincing to your angel investors if they, are just kind of having their financial model and they're kind of predicting what their revenue might be in terms of that multiplier. Is that something they're convinced of, or what method would you, for these early stage startups is more convincing to?
So you can't currently value a startup on projections. So you can't look and say, hey, these are my projections for 5 years out, and so I'm worth X dollars. And you just can't do that. You're worth what you are worth today before people put money into you. So if it's just an idea, I'd say the going rate for that is anywhere from $1.5 million to $4 million pre-money. And I think you'd be very hard pressed in this area, in this market, to find anything higher than that. If you don't have any sort of traction, if your idea isn't solidified, and if you don't have any sort of prototype, that's how our market is.
What if they have IP? So most of the companies that Murray is working with, they have IP, or are developed or are moving towards IP. Does that add any?
Again, that goes back to the arts. That's the rock solid IP. How good is your IP? I would say that would definitely. If you have IP, you're probably not going to be looking at a $1.5 million pre-money valuation. That's going to be more 2 guys or 2 gals and with their idea on a napkin. So I would say, depending on the IP, depending on the market, that would be a little bit higher of a pre-money valuation. Does that answer your question?
And I guess the situation that many of the startups are is like, they know they need to raise X amount of money towards, on this round to carry out a particular set of proof of concept experiments. So again, you could go to the BC method and expect that. But again, what is your advice for those companies that, like, let's say they want to raise $2 million because they know they need to buy X amount of machinery to kind of carry out what they're trying to do. But again, they have nothing. They have no revenue. They just have their intellectual property.
So for that, you could look at raising a convertible note, since it is so early, and not put a price on it. So a lot of early stage companies, very, very early stage companies, will raise money from friends and family or do a really, really early convertible note. And that'll put a cap. Are we familiar with convertible notes? You can nod or shake your head. I can see you guys.
I think going over that would be helpful.
So a convertible note it's technically debt, and it says, all right, instead of raising $1 million in equity, I'm going to give you $1 million in the form of a convertible note. And whenever you raise your next round, my convertible note is going to convert at the price of the next round without us setting a valuation today. And SAFEs, which is a simple agreement for future equity, is similar. And what it does is it kicks the can down the line for valuation. It doesn't set a valuation on the company right now, but it also and it will give the convertible note holders an incentive to invest early by giving them a discount on the next round. So some people will say, all right, I'll raise $1 million convertible note, and that'll be at a 20% discount to the next round. So if they've raised $1 million convertible note at a 20% discount, and the next round is raised at $5 million pre-money, then the convertible note is going to convert at $4 million pre-money. So they'll be getting more shares per dollar than the next round. But it allows the startup not to value themselves previously at, 2.5 million. And if they're raising 1 million, they're giving up, like 30% of their company. And that's a little bit higher than that 20 to 25% that people typically are comfortable giving up per equity round. That's a little bit confusing, but that I would say for really early stage companies, a convertible note might be the way to go if they need more money than would
And would you say, Chelsea, that that's similar pattern that you see with angel investors compared to a strategic investor or others? Would they also be willing to, in your experience, also comfortable with convertible notes?
Angels, most of them are. Our particular angel network, we've done one convertible note. We got burned on it pretty bad, and so we haven't done convertible notes, nor do we intend to. And the reason that works out for our group is because the deals that we look at are generating revenue. So they should theoretically be able to have fair valuation put on them. The note that we got burned on was that AI company. And basically we invested with a larger VC fund that did away with our discount. It wasn't pretty, it wasn't fun. So we just haven't done convertible notes ever since. But most angels are more comfortable most individual angels, other angel groups, it depends on the group, are comfortable doing convertible notes. Some people hate them, some people love them. We just don't like them.
Thanks.
Yeah. Any other questions on how to value a startup before I move on to the due diligence?
So if you have disparities between different valuation systems, for example, it's multiples and VC method comes a different number, and what other factors do you determine the valuation of the company?
So that's kind of the art, right? Like if the multiple pre-money isn't quite adding up with the VC, I would probably go with the multiples over VC. To me, that would say, well, maybe they're raising too much money or not enough money. Yeah, I personally prefer multiples. That's what I use. I say 3.5 out of 5 times. That's just how I operate. I'd say VC method is more of a checks and balance that I use. So if I look at how much somebody's trying to raise, if it doesn't fall within that 20 to 25%, I'm going to start looking at, why are they raising what they're raising? Should they be raising more or less?
Gotcha. Thank you.
So I usually make sure the valuation is in line before I go into any sort of due diligence, because there is nothing worse than spending 3 weeks digging into a company only to find out that we don't match up on valuation. Sometimes we'll go to a company and say, all right, we've looked at the comps and we think your pre-money is X. And they say, oh, well, I think that's way too low. We're, instead of 10 million, we want it to be 18. And we're like, we just can't get there. And then you're in an impasse. And if somebody is not willing to move, or if you're not willing to negotiate, then there's probably no point of us moving on to due diligence, because we're not going to do that deal. And it needs to be something that both the investor and the founder are comfortable with. I mean, you don't want people to feel like they got a bad deal on either end. You don't want the founder to be angry that they gave up, way more of their company than they felt like they needed to. And you don't want investors that feel like they don't have their money's worth for what they've put into the companies. You really, the art of the negotiation is to make sure that both parties feel like they got a good deal. And that creates the best working relationship for going forward. I just got off on a tangent. So let's move on to due diligence. When I was first starting out in this business, I had a mentor that told me these are the 3 things that actually matter. And you should ask yourself these questions throughout the entire due diligence process. What is our investment thesis? What needs to happen in order to achieve the return that we want? And what can possibly go wrong? So, what is our investment thesis? Why are we investing in this company? Let's see. One of our portfolio companies is Carpe. It's the sweaty hand and feet lotion. Really weird market. The guys are awesome. The growth is awesome. The product, I don't have sweaty hands and feet, but I hear it's awesome. So what was our investment thesis for Carpe? We really liked the founders, and we felt like they had a good product that could penetrate the market. So we invested in Carpe because we thought that they could achieve a certain amount of revenue in a certain amount of time and sell the company within X number of years. I don't remember how many we modeled. So that was our investment thesis. And then what needs to happen in order to achieve the return that we want there? They would need to get into a certain number of retailers. They would need to achieve X number of sales. And then they would need to sell the company. And what could possibly go wrong? A lot of things can go wrong. COVID could happen where nobody goes out of their house and they have no need for sweaty hands and feet cream. Weather-related things could happen. They could maybe not get into the stores that they wanted to get into. Manufacturing issues could be a problem. Founder issues could be a problem. These are all things that we think about when we're doing due diligence. So those are the 3 questions that I ask myself throughout every single section that I look at when it comes to a company. And we should always be asking ourselves, does this make sense with our investment thesis? What needs to happen in order for us to achieve 10x, which is our gold standard for returns? And what could possibly go wrong? And then how do we mitigate those risks? So for due diligence, this is super simplified, guys. There's way more that goes into it than just this, but these are the major components that I look at. I think I mentioned before that the team is the most important to me. I'd rather have an A team with a B product than a B team with an A product, because the people that are going to make it happen are on the team. So they have to be go-getters. They have to be coachable. They have to be genuine humans. And I know it sounds kind of weird, but there's nothing worse than just dealing with a jerk, because you know that they're probably not going to be honest when it comes to how they deal with their investors if they're not honest in general. So good people. So for team due diligence, what we do is we'll do a number of reference calls. So we'll call other people that report to them. We'll call people that they've worked with in the past. We'll call people that we trust, that they know that they know that they know. We do, I'd say per person, we do at least 3 to 5 reference calls on the founders. And we really ask like, not personal questions. So we're not like digging into their lives, but we want to know, how does this person treat people? Are they coachable? Do they listen? Do they have an ego? How are they as a manager? How are they when it comes to hiring people? And we will kind of look for themes when it comes to the team. So for Carpe, as a good example, David and Casper, they were the co-founder, or they are the co-founders of Carpe, and they were very young when we first invested in them. I think they had just graduated undergrad. And, you know, inexperience is a little bit of a concern. They didn't have any real business experience. But we spoke to a lot of their references. Everybody said that they're extremely coachable. They listened. They didn't have an ego. And that's something that we were very comfortable with. And we thought, okay, well, if they listen, if they take advice, then what we'll need to do is put a good board into place so they have good advisors around them. And that was, you know, let's go back to what needs to happen in order to achieve the return that we want. We need good management in order to drive the company to achieve the return that we want. And so going back to the team, I checked that box. We'll look at technology and the IP around it. So is this defensible? Does it have a competitive advantage? We'll do some IP review. Not all of the companies that we invest in have IP. So if you're looking at more of a tech, typically doesn't have a lot of IP around it. More of your life science is going to have heavy IP. So we'll look at both of those. We'll look at the competitive advantage. How does it stack up to its competition? We'll look to make sure that the market is big enough. So I'm sure you guys have heard of something called a TAM, and that is the total addressable market. And we'll figure out what the TAM is for each of these investments that we're looking at. And the TAM needs to be big enough in order for us to move forward with it. So let's go back to, when we're looking at TAM, we go back to what needs to happen in order to achieve the return that we want. The total addressable market needs to be big enough in order for them to achieve a decent amount of sales in order for us to achieve the return that we want. So it's always going back to these 3 questions. So to calculate the TAM, we'll look at, let's use Carpe as an example. We looked at the number of people with sweaty hands and feet, also known as hyperhidrosis, it's excessive sweating, and multiplied that times the price per tube of Carpe times the number of times that they would purchase it per year. So I don't remember how many people actually have sweaty hands and feet, but we'll use a really simple example of 100 million people have sweaty hands and feet in the United States, and the price per tube is $6, and they're going to buy it twice a year. So that's what, $1.2 billion total addressable market. Checks the box. It's big enough for us. I'd say anything under 250 million is too small. And then we will look at the deal financials. So we'll make sure that the pre-money matches up. That's something that we've already looked at before we dive deep into this. But we'll make sure that the exit returns match up with what our expectations are. We like to achieve around a 10x return over what we model is about 5 years. Nobody knows when these companies are going to get sold, but we use 5 years as kind of a main assumption for our models. And then we go through what could possibly go wrong. What could possibly go wrong with the team? They hire the wrong people. What could possibly go wrong with the technology? The IP isn't buttoned up, or maybe it is. We look at what could possibly go wrong with the competition. This competitor has more funding and the same competitive advantage. That would be a huge negative. So we look at all of these different sections and ask ourselves these 3 questions. And then what our reports look like is I usually do like a 6-page report of all of these sections and then summarize the key risks and merits. Carolina Angel Network doesn't make recommendations to our investors because we are part of the university. So, and they, for liability reasons, don't want us making recommendations. So the investor will be able to read the key risks and merits and decide for themselves if they want to invest. Other angel networks, other VC funds, other angel funds will make more of a recommendation, but they make those decisions by looking at all of the key risks and merits for each of these major components. Questions? I just talked for a long time.
Chelsea, what do you think from a due diligence perspective? Do you take all this information and give it back to the actual startup company? And you may have said that, I may have missed it.
So
do you give it?
We don't. I will have calls with founders after the fact, and surprisingly, I've only had maybe 1 or 2 founders say like, hey, can we talk about your due diligence findings? I want to see if you came up with any like red flags that we can improve on. I'm surprised that only a couple have asked that. But we don't share the report mostly because of the reference checks that we do. And there are a lot of direct quotes in there, and we don't make opinions on the founders, but we will critique them as far as their personality goes. And there have been a couple of portfolio companies that we've said, we don't think that this person is long-term CEO quality, and nobody wants to read that about themselves. And it is part of our assessment, but it's probably not worth hard feeling, right. If that makes sense. Right. But I will we're about to close a deal where I thought the returns, so I was looking at the deal financials, I looked at the comparable transactions and modeled out what I thought the exit would look like. And the return numbers were pretty low. It was nowhere near 10x. And I talked to the founder about it, and I was like, look, the biggest red flag in our due diligence were the returns. So it looks more like a 4x than a 10x, and that's not necessarily a bad thing, but it's definitely not as attractive. And he said, well, let me send you some comps that I found. And it became more of a discussion, which was nice. At the end of the day, we did changed some of our comps, and so it became a little bit higher of a modeled return, but it was a good exercise to go over.
And are these all, it sounds like it's very, like there's a narrative around each of these. Do you put them into any type of a weighted system kind of spreadsheet where you kind of do an analysis or anything like that to take a little bit of that personality out of it?
So
Or-
we do not, only because we look at so many different industries. So if we were only looking at B2B SaaS companies, it would be a heck of a lot easier to put it into a spreadsheet, because then we'd be looking at apples to apples, right? And we could stack up all the companies that we looked at within a year up against each other because they have similar characteristics. But we'll look at a biotech company and like trying to think of a completely opposite example, but like, or a grocery company, and it's very hard to compare those two. So what we'll do is we do more of the risks and merits and a return, and we'll look at the returns. And if the risks outweigh the merits, it's probably not something we're going to move forward with. If the merits outweigh the risks, that's probably something we're going to move forward with. But always, 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 it needs to make financial sense.
That makes sense. Thank you.
Yeah.
I have a question. Is it more common that you guys are looking for companies to invest in, or the companies and the founders are coming to you?
It's both. Right now it's so it's both. I usually get a pretty steady stream of applicants. When COVID started, everything kind of came to a screeching halt, and I'm just starting to see a pickup in deal flow. I think everybody was trying to figure out what the heck was going on, and what their next move was. But it's both. So I hit up the normal startup scenes. I'll keep up to date with people that are in the news and reach out to them proactively and follow companies that I have heard of or that have been sent to me by members or by other companies. And then we have quite a few companies that will just apply online, and then we'll look at them that way. I'd say the best, if anybody is looking for funding, obviously we'll look at everything, but I find it best if there's a warm introduction. I think that's probably best with pretty much everything. So via Cheryl, via Maria, Haley's part of our team. Are you on here, Haley? I thought I saw you.
I am on here, sorry.
So warm introduction is a good way to get in touch with us. But anybody that applies, I'll read through their deck and usually set up an intro call, unless it's just absolutely something that we wouldn't look at, which is real estate and nonprofits. We don't look at.
And maybe you could tell a little bit more about the team and the due diligence when you're looking at people. I mean, obviously there's the red flags that people are not coachable, but is there anything else that you kind of would like to see in teams? Like, I guess somebody in the technology side, somebody regulatory, and so on.
Yeah. So for team, I typically don't look as favorably upon single founder teams. There can be arguments for and against that, and we have invested in single founder teams, but usually we like to see At least one other person is on the management team. I like to see somebody with sales and marketing experience. So if you have a bunch of scientific founders and nobody with sales and marketing experience, that to me is very scary. Or at least like have the wherewithal to hire somebody to get in that position. So yeah, sales, marketing, not single founder. Try to shy away from husband and wife teams for obvious reasons. I like to see a good board, or at least the plan to put a good board of directors in place. Yeah, I mean, you'll hear a lot of people say like, oh, we like serial entrepreneurs. And sure, I do too, but you got to start somewhere. So I'm not so picky when it comes to prior entrepreneurial experience. I do think that great entrepreneurs can be made the first time. All right. Any other questions?
How long does it take you to go through the process of due diligence?
It depends. Sometimes it takes a while. Other times it's a little bit faster of a process, but I'd say average from start to finish is probably about a month. I guess I didn't really mention when it comes to technology, we'll do a lot of industry expert interviews. So like right now, we're looking at a red blood cell health test for sickle cell disease, which I am really not an expert on sickle cell disease, but I have spoken with 4 people that are experts. So sometimes it takes a lot of time to get these people on the phone, a lot of times to flush out what the major issues are. But typically about a month. I'd say anything less than 2 weeks, I don't feel like we've given it enough time. 3 weeks feels rushed, but it's doable. A month is pretty good.
Thanks.
Yeah. And they say that there's a correlation. I read this somewhere, and I absolutely believe it's true, that there's a correlation between the amount of time that you spend on due diligence and returns. So more time you spend on due diligence, the higher the returns. So here's my contact info. If you guys want to shoot me an email, feel free. You can ask anything. Or if you need advice, feel free to reach out.
So, Chelsea, and I think I have some of this information, but it may be also helpful. How many projects or companies do you kind of look at on a regular basis, and how many of them actually make it to a valuation and then due diligence? Kind of take us through what that funnel looks like, if you don't mind, just for 1 minute.
So I will look at about 150, maybe 200 companies a year. I'd say that's a little bit lower than other groups, only because there has to be that UNC connection. So that limits our pool. And, I don't want to say like, it might not be the right thing to say like how many of them make it to valuation. It's how many of them are going to make it to due diligence, and then how many of them are we going to invest in. You can value any of these companies, right? Like if we have 200 companies that apply and we ask every single one of them, hey, what's your pre-money valuation? It doesn't qualify them negatively or positively, doesn't move them on to the next step. But Of the, like, we'll use 200, of the 200 per year that I look at, I'm probably going to take a deeper dive into about 20 of them. Maybe 20 to 30 I'll do like light due diligence on. So I'll look at that market, look at some comps, decide if it's something that we want to do a full dive into. And we probably do a full dive into 10 of them. And of those 10, I'd say we probably fund 8. So it does get narrowed down quite a bit. And the reason it goes from 10 to 8 is sometimes we might find something in due diligence that's just a deal killer. And we say, you know, didn't really see this one coming, but we cannot get comfortable with that. So let's go to what needs to happen in order for us to achieve the return that we want. If one of those things that we find is going to prevent us from achieving the return that we want, it's a deal killer. So we'll kill the deal.
Do they ever come back around?
Yeah. Oh, a lot of people come back around. There are companies I've been speaking to for over 3 years that will keep us up to date. There are companies that I've said no to twice and then said yes to a third time because they just weren't ready yet. They weren't there yet. And then they said, you know, let's meet up. Let's go over the progress that we've made in the last 6 months. And I'm like, okay, you guys are there. Let's do a little bit more digging into this. Like, I met with a company via Zoom this week that I've been following since 2017. And we had started doing due diligence on his company in 2017. Something happened, the deal stopped, and no hard feelings. We kept in touch with him. He's probably given us updates every 6 months or so for the last 3 years. We spoke yesterday. It looks like I'm ready to re-engage. So I'm going to move that one to a light due diligence phase to decide if we want to do that deal.
Interesting.
It's a long game, that's for sure.
Well, does anyone else have any other questions for Chelsea?